Hi, everybody. Welcome to today's webinar. This is RiskScout's monthly webinar. RiskScout is committed to providing insightful, thought-provoking content to bankers interested in starting and growing new business lines at their financial institutions. We provide a mix of personal and professional development to give you the tools you need to be successful. My name is Kristen Parker. I'm the Director of Compliance here at RiskScout, and joining me today is Ryan McInerney, and he's the Principal Product Strategy at RiskScout. This month's webinar is entitled Ask Us Anything, and it's related to any and all questions BSA and high risk related. Following the webinar, all registrants will receive a link to the recording via email. Our presenters will leave some time towards the end of the hour for our registrants to pose questions. If you have any questions you'd like to ask, please put them in the chat box in the lower right corner of the screen. That takes care of all of our housekeeping items. And just again, as a reminder, all registrants will receive a link to this recording via email. So to kick us off, I'll give you a little bit of my background here. As the Director of Compliance at RiskScout, I have been with RiskScout for 2.5 years now. But prior to that, I've been in banking for nearly 20 in the front of house and the back of house business development, and then BSA AML compliance the latter half of my career. I've banked about every type of individual and higher risk type of industry under the sun, so I've got the personal experience of knowing what it's like to do it from a BSA officer perspective. And now I get to work with institutions all over the US to help them set up new programs, shore up existing programs, get to work alongside regulators quite a bit in this space as well. So I'm excited to be here with you today, and I'll pass it over to Ryan.
So my name is Ryan McInerney, been with RiskScout for about 1.5 years on the product strategy side of things. So I help to figure out the problems that are ailing all of y'all and figure out how we can change things we're doing in our software to make your lives easier and address the problems that aren't being addressed elsewhere in the financial ecosystem. Prior to this, I was a regulator with the OCC. I was fortunate to work in a lot of different business lines there. So mid-sized community bank supervision, large bank supervision, systemic risk. And then some of my specialties there were the BSA side, compliance, and then lending. So I worked a bit on the commercial credit side in the Northeast as well.
Great, thanks, Ryan. So today's agenda, we've already done, we can mark off the top of the list. We can check that box. We've given our backgrounds. Let's talk through instructions for submitting questions. We'll go through the question and answer session, and then we'll give you our contact info if you want to follow up with any additional questions that you may have. We did receive quite a bit of questions come in from you during the registration, but feel free to add on additional questions as we go through. This is how you would submit a question in this webinar today. So if you want to ask anything additionally, here's some good instructions on how to do so. We've got a lot to cover, so I think we should just get to getting here. We're going to start with a question regarding ESG and AML. So we had somebody asked the question, Ryan, about the significance of ESG and sustainable finance to mitigate banking risks. And maybe you can start with explaining what ESG is to begin with and go from there.
Yeah, so ESG is environmental, social, and governance. It's standards really related to social consciousness and environmental consciousness. So the OCC, when Comptroller Sue came into his oversight position, started to focus on this a bit more, particularly on the climate side of things. So just in general, there's some good guidance on that. Principles for climate-related financial risk is typically tailored more towards large banks, but a lot of times when you read these things, you just know how examiners are starting to approach them. When I think about ESG linked with AML, there's kind of two ways to think of it. One is from just a risk perspective and profitability of, say, a customer or member type. And then the other side is if your institution has taken a stand where they want to be more environmentally, socially conscious from like a reputation or a branding perspective, then you're looking at it a little bit differently. So I'm going to approach it more from the financial risk side of things. And so when you start blending anti-money laundering risk with environmental, social, governance type risks, you really want to be looking at the profitability analysis for the customers. So I don't see a ton of direct overlap, but where I see the overlap is on the profitability analysis. And so, for example, if you were thinking about, say, a crypto miner or something like that, a miner is going to use a outsized amount of electricity. And so if they're using an outside amount of electricity, then they have a higher impact from a climate perspective. That's something that the Biden administration had noted that they were going to be reviewing as part of that crypto release they made in March of last year. So like, let's say hypothetically, the administration decides to do something about the electric impact of miners. Well, that could negatively impact the profitability of that entity and thereby increase the potential financial loss to the institution. So that would be one factor that I consider as a potential stress for that customer, reducing that profitability analysis. Then when I start to loop in the anti-money laundering side of things, it might be a little bit more burdensome for me to monitor that crypto related entity. They could be technically considered a money service business, depending on how they do things. So with that additional monitoring, maybe software, maybe personnel, think about the additional cost that's there. And so when I take the governance, the environmental risk side of things, I take the AML side of things, and I start to add those costs in, then I determine whether or not I want to be in that space and whether or not that's actually a profitable segment for me. And that could work for a lot of different industry verticals.
Thank you, Ryan. Next question in line is, how many financial institutions are lending to CRVs? So that would be cannabis related businesses. And what has been the biggest hurdle? And I can start with this one, Ryan, and you can tag on if that works for you. All right. So the answer to how many financial institutions are lending to CRVs is, I wish we knew. It is quite a lot of institutions talking about lending to CRVs, but not a whole lot of them are actually pulling the trigger quite yet. So we are actually in the process of helping many of our institutions think through and have those conversations about starting a lending program, but very little have. It's a slow process for them to get comfortable in that space. A lot of the times it's maybe the board of directors has some issues with it. That the deposit side they felt was a little less risky than the lending side. A lot of other issues are regarding people's lack of understanding that they don't really need the safe banking bill to pass for them to be able to offer lending. That seems to be a big hurdle, is that people think that the safe banking bill is an end all be all and that will give them the green light to go. There are many institutions already taking advantage of lending, and there is no safe banking bill, and we don't know when it will pass or if it will pass. So it's important to obviously weigh out your institution's risk appetite and understand the varying risks of lending. You don't want to lend on crops and other variables that could be a potential issue from a legality standpoint, but there are other ways to go about lending and doing it successfully, and we're watching many institutions navigate that path pretty successfully. Ryan?
Yep, so I think that's all great information. We did a speaking event at the Risk Management Association last year. I want to say it was during the summer last year. And there was around 100 institutions that were in attendance there. And we asked the question, how many institutions are lending to cannabis right now? And not one person raised their hand. And so that was either they were apprehensive to let everyone know it was them doing it, or everyone really isn't touching that space. And a lot of the conversations we had with bankers that were in the lending side of things, they were far less informed on cannabis regulations and the ability of what they can and can't do than, say, BSA and risk personnel. So I'd say the first thing there is just having conversations between the business lines and making sure everyone's kind of on the same page so they know what they are allowed to do. Up until this point, CRB lending, cannabis-related business lending, has largely been handled by private lenders. And a lot of those private lenders have charged some pretty significant rates on that too. And it could be on types of debt that aren't even considered as risky in the space, like commercial real estate. So when we think about lower risk lending like commercial real estate, because one of the other questions we have in here is what safety measures should be in place. Some of the biggest hiccups that could be there, some of the biggest hurdles was one, not considering what the highest and best use of the property would be if it wasn't used for cannabis. So a lot of times if you have a cannabis company that has taken a space, they can sometimes get away with having these commercial properties that are maybe farther outside of a business district because there aren't a lot of alternatives. And then the highest and best use outside of cannabis, that space can't be used for the same type of retail activity and be successful. So if you're deciding to do that sort of lending, making sure you're doing some sort of stress testing or analysis there where you're saying this potentially could not be worth as much in the event that we had to foreclose on the property. Let's see, what other, and I'm going to try and think of some other safety mechanisms that we could use here. So other pieces that we might want to look at are the disposition of collateral if you were to repossess anything that was related to a cannabis related business. So a lot of that collateral won't be related to cannabis directly, say if it's the real estate. But if you have filed a UCC on say materials and equipment, if you were to have to repossess that material based on your geography, would you be able to take possession of it? And if there are requirements in that geography where you'd need to have some sort of licensing or have to be maybe involved in some sort of paperwork, making sure you've done that for your workout department so that they actually can take possession of those assets, or you have a third party to take possession of those assets for you. Let's see, what else? And then I'd say the other piece you might want to just think about is stress testing. So stress testing debt service coverage ratio of the individuals that you're lending to. So for example, if there was a federal legalization and then taxes increased, how would that actually affect their profitability? Because a lot of the cannabis industry actually doesn't operate from a profit. And I believe the last time we looked at those stats, it was about 50% of those individuals were operating at a profit. And then there will be some other areas you can stress test like supply chain, legality changes, those sort of things.
Thank you, Ryan. All right, next up, what are some common missteps that you see financial institutions make while working with higher risk business lines or growing existing relationships? As somebody who has done this as BSA personnel in my life and then seen how a lot of institutions operate now, one of the biggest missteps they make is believing that it's their job to police the industry to the nth degree. That is not what the regulatory expectations are. The regulatory expectations are that you build a reasonable and achievable program. And that means that you are really thinking of the true risks to your institution. You're thinking about the regulatory requirements for banking the industry. And you are building out a program to help you mitigate those risks to your institution. And that doesn't mean that, let's just say you're in the hemp banking space or the cannabis banking space, that you have to police the industry in regards to digging deep down into the business itself, right? It's there is a risk-based approach. So let's just take hemp banking, for instance. Hemp banking, when it first launched, we didn't have much direction at all. So we designed programs that were basically over-engineered because we had no guidance to kind of tell us what we needed to do. And because of that, we started collecting certificate of analysis to check for THC levels within the plant. We started digging really deep into licensing. We started really digging deep into website reviews and things along those manners. As the industry has matured, we're about 4 or 5 years past the Farm Bill passing, We learned lessons along the way. We have learned what, as the regulators have become more educated and are banking, are examining banks with these different types of offerings, they're learning more, and we're coming together and being able to collaborate with them better to say, what is it that we're really supposed to be understanding about these businesses? Because we know it's our job to know our customers, to know our businesses, but to what degree when they are a higher risk industry? So in regards to the hemp space, in the last 2 years, we've been seeing institutions and regulators become more comfortable with backing off asking for certificate of analysis because there's no industry standard to review a certificate of analysis. There's no industry standard for issuing one. There's no standard, there's no stamp of authenticity on lab results to even prove that the one that you're looking at is real. So we were spinning our wheels as bankers trying to look at these certificate of analysis when really that's the job of the agency that has licensed that business. So there are ways to understand that or make them attest to and adhere to the fact that they are going to follow the rules of their state for certificate of analysis. There's different ways to approach that piece of the puzzle. You don't have to become experts or lab experts at your institution to be able to read those. We used to look at website reviews, do website reviews of hemp businesses. Well, when speaking with regulators and years of doing so, we've learned that we can back off of that because there are different components within a website review that are not really the duty of the institution to have to dig down and into review. So there's really finding that balance in there of what you should be doing as an institution and what you can rely on the licensing agencies to do, and then what onus you put on the business, maybe through attestations. The other issue we see a lot is over collection of documentation. You can ask 100 questions on an application, but what are you doing with that information that you're collecting? It's almost better to collect less information if you're not going to be reviewing it than to have more information that's just sitting in your files and that you haven't looked at. That's a recipe for disaster and a potential that your regulator may come back to you and say, well, you had this information and you didn't do anything with it. So it's finding that right balance of what information to collect back from the business. The other issue is scalability. So when an institution is scaling up a program or wants to scale up a program or has started a vertical, and they think that they can go into it and do it manually from the start. If you're only really truly expecting to have 1 to 10 clients, maybe you can do it manually. But most institutions that invest into wanting to grow a vertical and invest the time and the energy into creating that vertical, they don't want to just have 1 to 10 clients. That risk is not worth it to them for that little of profit, the little fees that they can have, the little amount of deposits. So it's usually a scalability thing. So what a lot of institutions do is think that they can get into this type of program with their existing technology that they have in place, and only to find out, several months later that, or not even several months later, sometimes even quicker, that they don't have the right tools in their pocket to scale this, and they're having to go out and either find staffing or backtrack to find technology. Staffing is hard to find right now. We all know that staffing is difficult to obtain and it's difficult to maintain. Staffing takes vacations, software doesn't. So it's a big problem that we see often from institutions that we are often talking to that scaled up a program and are now kind of hitting the panic button because they're saying, what do I do? I have 100 clients and I only have 2 people on staff to handle them. Ryan, you got anything to add there?
I think I'll just expand on the scaling one a bit. So programs do tend to grow faster than anticipated, but in the situations where we haven't seen a program go as fast, it might be due to overcharging. So, for example, like if you saw someone marketing a 1990 Accord for $10,000, despite how desirable that might be, no one's probably going to pay for it. And then the second might be a failure to market. So some institutions choose to not have these programs publicly marketed, but that will come with a slower acquisition rate of different potential customers. Right? If we go back to the Accord example, no one's going to buy the car if they don't know if it's for sale. You could have someone who's a avid 1990 Accord collector that might actually pay $10,000 if they saw it. So marketing and appropriate pricing, just really important.
Yep. Yeah, and along with that comes, I think we probably have webinars we could point you in the direction to that we've done in the past about understanding your market. Those that go into their market not understanding what their institutions in their own footprint are charging or what services or products are they're offering, that's often also a misstep because they may overprice, they may underprice. And a lot of times when you underprice, they will flock, and is it going to be garbage in, garbage out for you? Not having appropriate filtering mechanisms in place to ensure that you are spending time on applicants that may better fit your risk appetite, that you're not spinning your wheels on potential applicants that may be not within your risk appetite or not within the goal of that program altogether for your institution. So we could go on and on about that one, couldn't we, Ryan?
Yeah, I have limitless bullet points on that.
That's right. All right, but for sake of time, let's go to the next question. What are your thoughts on cannabis businesses using crypto as payment to and from vendors? I'll let you take that one, Ryan.
Yep. So anytime you're seeing crypto used as a payment, I mean, it's really following the same rules, regulations as any payment type. I think one of the biggest things you want to take a look at there is just making sure that funds aren't moving or interacting with sanctioned wallets or exchanges. That's the conversation we've had with law enforcement, is that's kind of the biggest thing that they care about.
Great. All right. What is the expectation in keeping declared activity for businesses updated? Mr. Examiner over there, or former examiner.
Yeah, former. Let's make sure we say former.
recovering examiner.
Mm-hmm. So I guess keeping declared activity updated. There's kind of two ways you could look at this. So when you open the account, that declared activity on the front end is really so you can establish what expected activity would be prior to you actually having activity going through the accounts. After that, I mean, you're probably better off just looking at what the account is actually doing. But you can refresh that maybe annual basis. I don't think anyone's gonna ding you regardless of the frequency on that, but annual would be good depending on the complexity of the business. If it's, say, like consumers, individuals, I mean, you're probably not checking over and over to see what that declared activity might be for that individual. But on the business side, looking at what the activity is on the account and seeing if there have been major deviations in activity. So if they've been changing like by 10% per year, that could be just normal growth. If you see the business has changed like 200-300%, and you can't really explain that sort of thing, that would be the point where I expect somebody to go check what's actually going on there.
And I'd say too, it's dependent on your institution's risk appetite. So if you're dealing with these higher risk industry sectors like ATM, privately owned ATMs, crypto, cannabis, the expectations are going to be different for those than your just mom and pop run of the mill businesses that you have maybe at your institution. It's going to I always encourage this think through during the program build. So if it's a higher risk vertical, maybe you want to be adding into your policies and procedures that you're going to refresh the EDD information that on a set cadence. So a lot of our institutions, depending on the risk, maybe if it's a cannabis related business, then they are doing it every 6 months. If it is an ATM business, maybe they're only doing it once annually. That way they are ensuring, because this is slightly higher risk, let's just say, for example, in ATMs land, the activity may look completely different in the account, but if you don't check on with them, and it may throw up red flags, but if you check in with them on a reoccurring basis and understand how their industry is growing, how their business is growing, maybe they've added additional locations for the ATMs, maybe they've got a different courier in place now that's taking care of filling the ATM, so on and so forth. Those are the things that you need to understand about those businesses, not just at onboarding, but on a reoccurring basis, so you can ensure that the activity occurring in the account is actually commensurate with the stated nature of the business. So you need a good way to do that efficiently and effectively. Traditionally in institutions in the lives I've lived before, you'd have to go through your business development officer to go to their customer or member to collect the information, and maybe they send it back to you and it's 6 months later and you're already behind on reviews, and this is just setting you further behind on reviews. There's better ways to go about automating that reoccurring collection of due diligence information. But I would say you should really be thoroughly thinking through, and especially in the higher risk verticals, of in your procedures, a set cadence of when you're going to recollect information from those businesses, so you can really truly understand what's going on at the business and ensure the activity looks reasonable for those current business types and not just at onboarding. And I will warn you that cannabis businesses, hemp businesses, those guys, when they fill out their initial due diligence, they want to tell you about their activity. A lot of them think they're going to be millionaires. And then you look at the account activity and they don't have much activity going on, or maybe it's a slow grow, maybe it's all this. That's information you're going to have to update on a reoccurring basis if you're ever going to really understand if the activity is reasonable in that account. So just keep that in mind, that you need to really have some better efficiencies on how you're collecting that information.
Yeah. So in summary, through enhanced due diligence, just checking on a periodic basis if anything's changed with the business in general. And then if you're looking at from an activity perspective, there's been major deviations in activity, that would be a good time to check what's going on with that change.
Alrighty. So next we've got, what safety measures should I have in place when starting cannabis lending?
Yep. So when starting, I think the things we talked about before, so making sure you have a disposition and repossession plan in place and you have the ability to take collateral that you've taken as security. Stress testing, not only from a portfolio perspective, but also on the individual loan level prior to underwriting. And then you'll probably want to review those tests during reviews. And let's see, what else would we want in there? Maybe on the, well, definitely not maybe, it's from your allowance methodology, if you're using, say, like expected loss type methodology, you'll be adjusting, you might have factors that are adjusting those types of things because there might be a higher loss given default given the propensity for the collateral maybe to not be worth as much, or some other factor that you might see there. So stress testing on the individual loan level, maybe the portfolio level, deciding depending on the size, repossession, disposition plan, and I just blanked on the last one I said, but that was also important.
All right. All right. What are the primary concerns related to offering cryptocurrency transactions?
Okay. Could you repeat it, Kristen?
What are the primary concerns related to offering cryptocurrency transactions?
Okay. So primary concerns related to cryptocurrency transactions. I think the biggest one, it also goes back to the other crypto question that we were just talking about, is making sure funds haven't gone through sanctioned exchanges or wallets. That's really going to be the biggest thing, and making sure that however those funds are moving to you, it's really followed the travel rule. You know where the funds actually came from. And there's a lot of tools that are out there for you to check what kind of activity that wallet has been engaged with. Let's see. The other side, I guess if you're doing transactions, that's really gonna be it. It's when you start offering more services and that sort of thing that you might have a little bit more of an expectation from your regulator.
All right. What are recommendations regarding the extra overdraft scrutiny?
Okay, expectations regarding extra overdraft scrutiny. So I don't know exactly which scrutiny you're referencing, but I can think back to during exams when we were looking at things like overdraft line of credits and fees, all of that fun stuff. Really, I think a lot of the fee side of things is going to be covered by the CFPB. CFPB can be a bit aggressive, in my opinion, but I guess that's all of our problems. So just making sure fees are really properly disclosed. If you are doing any lines of credits, anything like that, the line of credits need to have proper underwriting. If you're doing those overdraft line of credits to insiders, say board members, management team, things like that, making sure those are within the dollar amount limits. So that should be within regulation. I can't remember the dollar amounts off the top of my head. I want to say it's like 500 and 1500, depending on what their role is with the institution. So just checking into that if you are doing that sort of thing. But fee disclosure and then making sure any overdraft lines are within the appropriate limits and approvals.
Thank you.
Overdrafts go down a unnecessarily complex route of regulation. So I wish you the best of luck on that one. And if you need anything, I'll be happy to try and connect you with people that can help out on it.
All right, if we could touch on the topic regarding the level of documentation needs for examinations, specifically how that has increased.
Okay, so the level of documentation on exams and how it's increased.
Yeah.
Let's see. It's funny because the documentation is going to be very much specific to the office that is requesting that information from you. So let's just give, for example, the OCC side. So we're going to have a standard request letter that we send out, but then that request letter is going to be tailored by the examiner in charge and the office to focus on risks that are specific to that region. A lot of the documentation that's requested is probably on the IT and the cyber side. I think a lot of that change coincided with the cybersecurity assessment tool because the regulatory agencies were completing that tool, and that tool is like, I don't know, it's got to be 100+ questions, if not more. And so there was a lot of supporting information that was required for that sort of thing. If you're looking for the type of documentation that you can provide and really like starts to limit the amount of questions you start to get back, is just going to be more on showing what your actual process is. Because a lot of the documentation that you provide, say a regulator or an auditor, is going to be artifacts that show maybe the result of something, or it's going to show like a policy, a procedure, but it's not going to show how it was actually implemented. So if you're using a system, if you're using a process and you have documents that kind of show how that process is working, providing that sort of information will definitely reduce the amount of questions you get, because the regulator or examiner, auditor can start to dig through that and get an understanding of how things actually function within the institution. A lot of the times the questions we're asking and the follow-up documentation we're requesting is just to better understand what the process is and how it functions in real life versus how it functions as you've written in your procedure, because like 99 times out of 100, those don't 100% line up. The spirit is there, but there's just going to be some nuances in how it's actually executed. Kristen, do you have anything to add on that? Because I guess you were the one that got stuck providing the documentation.
Yeah. What I guess I could add here is it really is dependent on also how, how your program's built out. Ryan touched on that. I can go back to the topic of over-engineering a program. And if you say you're going to collect 99 things from your customer or your prospect during the application, what are you doing with those 99 things? And they really want to understand, if you are collecting it, what are you doing with it? A lot of times I have institutions that say, well, I want to know if they have an insurance policy, I want a copy of the insurance policy. I want a this and a that, stuff like that. I'm like, do you even know what you're looking for in an insurance policy? And what's the worst that could happen if you don't collect it? And when you start to use that phrase, what's the worst that could happen if I don't have X, Y, Z, or if I don't collect this explanation from them, and the worst that can happen is, oh, I guess I know not much can happen here, then should you be collecting it at all? I have had examiners come in and, really hone in on, is this a balanced approach too? So is what you're collecting from your applicants at time of application sufficient enough for you to really understand the business, or is it over-engineered? And then what are you doing to ensure that what you have written in your procedures and your policy, that your policy is robust, that your procedures reflect what your policy's intent is, and are your procedures thorough, and are you collecting the information based on what your procedure says that you're doing it, on the cadence and so on and so forth, that you're doing so. So it's really always goes back to your policies and your procedures. Are what you are doing reflective of what your policies and procedures say? So I wouldn't say that necessarily that they want you to provide more now these days. If you've designed your program to be super complicated and you're asking for 150 things, and your procedure says you're going to do all of these things on a quarterly basis, and yeah, they're going to want you to prove that you're following your procedure. So that may be where the increased documentation comes from. But I always like to say, let's keep it simple here. Let's really think of what the true risks are of this industry, the true risks to your institution, and let's design a reasonable program that you can achieve with whatever size staffing that you have. And then you don't run into this your hair's on fire when you get your audit list or your exam prep list of these things that they're asking for, because you've got to provide them everything that's against your procedures or your policies, and you got to go to 100 different places to go get it. The more we can dial in programs and get everybody kind of on the same page, different institutions, on what we're asking for from these businesses, the more likely the examiners are going to get on that routine of understanding, okay, these are the basics of what should be asking for. And they're not going to expect that you have 150 documentations from this customer on a reoccurring basis to actually ensure that they're doing what they say they're doing and the activity is reasonable. They're going to say, okay, here are the 10 to 15 basic core things that every institution should know about if they are banking an ATM, or if they're banking cannabis, or if they're banking hemp. And I expect to see that in their program. And if I don't, that's when we'll have a conversation. And we're seeing more and more institutions, especially the ones that we end up working with, we're dialing those in with those institutions. And when the regulators go there and they say, oh, you've got RiskScout? Oh, we know that they've helped you design this piece here, then we know you're in good hands and you're in good shape because you've thought through it. All right, moving on here. How many FIs collect occupation during onboarding? Every institution I've ever worked at or worked with collects occupation at onboarding. It is not a CDD requirement. If you look in the FFIEC manual, in the customer due diligence overview section, it specifically says the bank may determine that their customer poses a higher risk because of the customer's activities, ownership structure, so on and so forth. If so, the bank should consider obtaining, both at account opening and throughout the relationship, the following information. There's a list of about a dozen things they could collect, occupation being one of them, but does not say it is required. So it's up to your institution's risk appetite. Brian, anything to add there?
No, I think that's spot on. I've never been to an institution where they didn't collect occupation. And I'll say one of the things that we would look at if we were doing due diligence reviews or customer reviews on the BSA AML side is we'd look for activity that didn't align with the listed occupation. So when there wasn't occupation, we'd just be like, well, why don't you have the occupation on this individual? It's, to Kristen's point, it's not a requirement, but I'd say it's highly encouraged because it's a simple data point. It's an easy data point that provides you a lot of information, particularly if you start doing peer grouping and that sort of thing.
I will say that occupation collected on onboarding is really beneficial to begin with, but I'm guilty enough that my original institution that I started an account with 15 years ago doesn't know the role I'm in today. So it will change over time. You've got to understand that you've got to do some risk rating and understanding of your client base to say, okay, when is it time for me to update their occupation? And most of the institutions I've worked in and with, that occupation will be updated on some type of reoccurring basis. And maybe that's because an alert triggered that caused some concern in that occupation, the activity in the account does not line up with the occupation, and that's one of the red flags. We may have someone reach out, or we may send out a task or some type of communication with the customer or member to update that information, so we can say, does that help us mitigate what's going on in this account, or is that truly maybe another factor in why this is even further a red flag? All right. What is the best way to monitor cash applications for potential compliance issues?
So when we're saying applications here, do we mean applications for like cash intensive businesses or like actual application, like
Let's go with
mobile app? Okay. Okay, if we are looking at, let's just say cash intensive businesses for compliance issues on an ongoing basis, if it's a cash intensive business that you have multiple of, putting that in a peer group, those peer groups will be helpful really if they're in the same geography or the same industry type. But if you have them kind of spread really, really far across the US where they might have different customer demographics and things like that, they might not be that similar together. So that one's a maybe. Other pieces to review there, I guess one thing we look at is variance of the income of the business versus the transaction activity that's occurring at your financial institution. So if you see massive deviations from that sort of thing, that's usually an indication that something weird is going on. Let's see, Kristen, you got anything else to add on that one?
Yeah, when you're dealing with cash intensive businesses, you really need to have, this is one non-negotiable area where you have to have a reoccurring updated understanding of the business. Because if it's cash, you need to be able to know where the source of those funds are coming from. And a better understanding of the business is going to help you better understand the source of those funds for the activity that's occurring in the account. When you have cash intensive businesses, you also want to potentially consider setting up some type of courier service for those businesses. from a safety standpoint from your institution. It's really important, not to have large amounts of cash in your institution from a public safety issue standpoint. It's also important to know that if you are dealing with these cash intensive businesses and you do set up courier services, it is still your responsibility to file a CTR. It is not the courier's responsibility to file a CTR. A lot of times when you're dealing with courier services too, in regards to cash intensive businesses, the settlements are coming in ACH to the institution and not through cash. So you'll want to make sure your transaction codes are set up correctly, because they may not feed into your core correctly as cash, which could make your transaction monitoring system potentially read it as ACH and not cash, and not trigger a CTR for your back office to submit. And you'll want to ensure you don't have that issue, so you're not potentially backfiling loads and loads of CTRs potentially. You want to always, from the very beginning of a relationship, if it's cash intensive and they're funding that account with cash or a check, a large check from somewhere else that maybe that check was funded by cash, you need to source the funds back and have them attest to where those funds are coming from, because you don't want to, by error or neglect, potentially that first deposit into that account or that first deposit in that ATM account, that ATM itself that you're banking, have an account for or relationship for, potentially be dirty money that you're allowing into your institution. So always have a way to source the funds, to understand that the cash activity in the account is actually reasonable for the stated nature of the business. It always boils down to that. And you need to have a way to measure that against something. All right. We have one here on examples of ongoing monitoring efforts when banking indirect cannabis or crypto companies such as a cannabis lender or crypto hedge.
Okay, so when we're thinking about indirect companies, let's see, when you sit on the crypto hedge piece, I'm not 100% sure what crypto hedge actually means outside of like the actual financial product. So I don't know how to answer that one, but I'll think about just kind of indirect crypto companies in general. One ongoing monitoring effort, depending on, the problem becomes these indirect companies have such diverse business lines. A lot of times it's going to be a little bit tailored to what they're doing. So if we're looking at an indirect entity that's, say, providing like accounting services, then you might be asking for whether or not they're doing things internationally, if they're doing services in certain states, what types of customers do they service, that sort of thing. So you're really just trying to make sure that the type of business hasn't changed, that they're continuing to do what you expected them to be doing when they started the relationship. I really think that's the most important thing on the indirect companies, is just making sure they haven't expanded, say, into a direct capacity, or if they haven't expanded into services that might be outside the scope and tolerance of your risk appetite. And that's going to go for the cannabis side. That's going to go for the crypto side. That's really going to go for any of these industries.
Okay, I got some clarification here, Ryan, on this one. This question was specifically for banking a cannabis lender and separately banking a crypto hedge fund that people invest in.
Ah, that makes more sense. Okay. Yeah, so if we're looking at a crypto hedge fund, the crypto hedge fund is going to be, I don't think it's going to be considered any sort of money service business, anything like that. So when you're looking at those sort of things, the lender and the hedge fund, you want to make sure that they have appropriate due diligence policies, procedures in place to vet the kind of customers that they're going to be dealing with, because your customer's customer kind of becomes your problem in those instances. And some of the things you can do on an ongoing basis, what we've recommended for any fintech relationships too, which I think kind of fall into this same sort of idea, is getting samples to make sure that they're doing things the way, like the indirect entity is performing their procedures in the way that you expected them to be performing them. So if you reviewed their policies and procedures to start off, you expect them to be looking at X type of documentation, performing X type of monitoring, double checking that they're actually doing things the way that you expect them to be doing them, because you don't want to be put into the situation where you're providing financial services and the due diligence actually isn't happening from that delivery to that third entity. So really making sure that they're continuing to perform things the way that they say they're going to be performing things. One example I usually use on this is if you had a relationship with, say, like an indirect auto lender, you might be getting information on a monthly basis from that indirect auto lender about the types of loans that were originated, the default rate of loans that were already in the portfolio, and maybe a subsample of some of the loans that were originated, making sure that documentation from a quality control perspective was aligning with what you expected. Now, that's probably going to be a bit more in depth than what you're expecting here. It just depends on the type of relationship you have with that entity. If it's a really, really direct relationship with that indirect entity where you're doing a lot of work with them, it's probably going to be a more robust monitoring relationship. If it's less complex, you might be just gathering some of that information, maybe like every 3-6 months, something like that, to make sure things are going the way you expect them to. Bottom line, looking at items specifically as they relate to the type of entity that you're dealing with. It's going to be a little bit more tailored.
All right. Thank you, Ryan. All right, one last one, unless anybody else has any other questions, would be best practices to communicate short staffing before employee burnout and depart due to understaffing, unmanageable workloads. So we can read that again, Ryan. Best practices to communicate short staffing before employees burn out and depart due to understaffing, unmanageable workloads.
Yeah, so I mean, I guess the way interpreting is that is you're trying to talk to your employees about having short staffing. I mean, the most important thing about that conversation is that something is happening to change that situation. If somebody was just telling me that we're short staffed and it's going to be like that in perpetuity, I don't think it would change much for my departure or something like that. If you're communicating that sort of thing because you're planning on making a change, make clear what the goal of that change is going to be. So we've had several institutions come to us and use RiskScout to implement some process automation to make that short staffing type of situation a little bit more bearable for the staff that are dealing with it. And so the idea would be you have that conversation, you say, what we're going to do is implement X solution. The goal of X solution is to reduce the amount of work you all are doing by this much. When we do that, it should make it so that you all have a more reasonable workload that aligns with what we needed for full-time employees for this program. Often, so this is kind of a tangent off of that, but a lot of times when we're talking to individuals about implementing some level of process automation, some staff get a little worried about that term because I'm sure we've all heard like the will robots take my job type thing. And on the Will Robots Take My Job, fun fact, there is a website called Will Robots Take My Job. I think it's something like that. And you can go on there and see the % chance and what parts they will take. But the idea is to take the pieces of that work that have an ability to be automated, put the automation in place for that, and then that enables your staff to reduce some of that kind of mindless workload, things where they might be just sending documentation back and forth. People are documenting the same thing. And then they're able to work on the things that are a little bit more complex, better suited for a human. So you're balancing that between people and process and technology. If you do that, you communicate that to your short-staffed employees that there is a change being made, whether or not that's the due diligence process, you're looking at a few vendors, you're solutioning a couple different things. Maybe you plan on using something like Zapier for smaller robotic process automation fixes that reduce some time, free up time. There's a couple options there. So just being clear with your staff about what you plan on doing. If that's adding staff, implementing technology, maybe a combination of both.
Yep. Yeah. I will say as As somebody who launched a hemp program very, very early on after the hemp farm bill passed, I thought that I would have a very small portfolio. And that was a mistake because we were so early on, nobody had anywhere to bank. So they all came to our institution. And as a result, I was very overwhelmed very quickly, and I had no tools in my pocket to try to help relieve or automate some of the processes. I say all of this because when you're launching a program, you may think you can do it manually to begin with. But if you think you can do it manually, please, please, please already have the conversations with your key leaders, your board of directors, that there's a limit to what you can do manually. And that they need to understand that they are going to have to make an investment into this program at some point where it hits some type of capacity. It's either adding people or adding tools, or both sometimes. The mistake that I made was I am of the personality type, I can't let anything go or anything fail. So I kept allowing people to onboard and running this program while having all of my BSA officer other duties. And it grew and it grew. And I kept saying to my management, this, raising my hand, we're at our capacity. I'm at capacity. I can't go any further. I can't go any further. I can't do more. We're going to have to. And their response back was, well, you've taken it this far manually, and we just keep doing it that way. I made that mistake. I didn't have the right conversation to begin with. And I tell you guys this because I don't want you to be me. I want you, all of us, as if we're in the BSA AML capacity at some point, are of that same personality type. We're going to keep that boat afloat because that's what we signed up for. And at what cost? Our own personal and mental health? That's not right. So have those conversations to begin with. Go in there and defend yourself as a person, defend your bank against potential failure, and have a contingency plan for the loss of your SME, which is oftentimes covered if you have the right tools in your pocket for somebody else to be able to come in and pick up and move on with what you were doing. Don't sell yourself short. Make sure that you take the time to have those conversations and understand the tools you're really going to need to be able to do these programs long term, scale them up, and be successful while keeping your brain powers, well intact here. That your program isn't going to fall apart because you're spending all your energy in this one vertical while all these other BSA duties don't stop just because you have this vertical. So it's really, really important that you have those conversations, that you have capacity set. If you are going to do this manually, this is what it's going to take to do it. This is the line in the sand. This is as far as it can go without people or without technology and the staffing that we have today. And get your buy-in early on for that so that you have the capability to get tools when you need tools, or you start out a program with tools. That's going to help keep your staffing better, staffing long-term when you're not burning them out. That's where I'll leave it.
Yeah, I'd say this is a little, this goes for really any industry, but if you're starting to scale these programs up, it's good if you're starting at the beginning to get pulse checks from the employees that are operating it. So even if you're sending something out, say once a day through an automated tool that just gives them like 5 levels of smiley face. And then you can identify as things start to change in the system, how those kind of pulse checks have changed for your employees. And when you start to see those really start to drop, that's a good time to have a conversation with your staff and see what the problem is, why people are stressed or unhappy, and what the best fixes are for it. and potentially you've already planned out what those fixes are. It's just a matter of determining when you start to scale up the program with technology, additional staff, etc.
Right. Because at the end of the day, we're all people, right? We are all human beings that would prefer not to wake up in the middle of the night and have to jot down a license you forgot to go collect, or, you know, so-and-so you forgot to follow up with. I've been there, I've done that. I want you guys to sleep better at night. And so I'm just sharing my lessons learned so that you don't become the person I was running these programs, massive programs, trying to do it manually. I had other tools. I had other BSA tools, traditional BSA tools. They just weren't designed to cover what is really needed in a higher risk vertical. So I just encourage you to just take the time to explore, have those conversations, and take care of yourselves because it's important. All right, that all said, we are over time, so I think we'll wrap it up. You guys, again, we'll get all of you will get a recording of this webinar. And if you have anything that you want to further chat about or talk about, Ryan and I would love to share our thoughts with you. So please don't ever hesitate to reach out. So on that note, thank you guys. Have a great day.
Thanks, everyone.